Welcome to the video. Today we will discuss why investing money that you need within 2 to 5 years in the stock market is a risky move. To begin, we will frame the core idea. Short-term capital must prioritize safety over growth. Then we will show practical, safer alternatives and a step-by-step approach to allocating funds. We will also include quizzes to test understanding and a clear summary at the end. Let's get started. First, we will walk through the immutable rule for short-term capital. Next, we will explain market volatility and recovery periods. Then, we will explore safer alternatives. After that, we will provide an actionable allocation guide, followed by a brief myth-busting section. We will then test your understanding with quick quizzes. Finally, we will end with a disclaimer and wrap up. To set the context, think of short-term capital as funds with a purpose and a deadline. When that deadline is near, the number one priority is preserving the principal. Therefore, placing this money into equities is akin to betting at a roulette table. You may get lucky, but the odds of a costly drawdown right before your target date are non-trivial. Consequently, we must focus on strategies that minimize the chance of loss over a limited time horizon. Here is the immutable rule. If you need the money within 60 months, safety must come before growth. Historically, the stock market experiences significant drawdowns of 20% or more without warning. Furthermore, recovery times vary widely and can stretch 5 to 7 years or longer. Because your timeline is short, the sequence of returns risk becomes severe. A 30 to 50% drawdown close to your goal date may not recover in time. Therefore, when the time horizon is short, volatility threatens your goal rather than helping it. As a result, we pivot to capital preservation instruments instead of equities. This timeline illustrates a common pattern. First, markets may peak and then decline by roughly 30%. Next, the market can experience a choppy period with partial recoveries during years 2 through 4. Finally, a full recovery might not occur until years 5 through 7. Importantly, if your spending deadline is within that 2 to 5 year window, you may be forced to sell while still underwater. Consequently, a timeline mismatch can translate into permanent goal impairment, reinforcing why preservation is paramount for short-term funds. Now let us shift focus to the practical tools. First, high-yield savings accounts offer immediate access and competitive rates versus traditional savings. Second, certificates of deposit allow you to lock in a predetermined rate for a specific term, trading some liquidity for potentially higher yields. Third, treasury-bills and other short-dated government bonds are highly liquid, globally trusted, and often come with favorable tax treatment at the state and local level. Fourth, I-bonds offer an inflation-linked structure, but they require a minimum 1-year hold and impose a 3-month interest penalty if you redeem before 5 years. Altogether, for short timelines, accepting a safe, guaranteed rate in the low to mid-single digits is far superior to the risk of a large loss right when you need the funds. This table compares core vehicles. High-yield savings accounts are immediately accessible and simple, though rates are variable and may lag inflation. Certificates of deposit provide fixed rates for a set term, with the trade-off of early withdrawal penalties if you need the money sooner. Treasury bills are highly liquid and considered very safe. They can be sold prior to maturity, although the price may fluctuate. I-bonds offer an inflation-linked rate and government backing, but they have a 1-year lock and a 3-month interest penalty if redeemed before 5 years. Each instrument aligns with a different part of the 0 to 60-month horizon. Here is a simple process. First, separate your emergency fund and ensure it stays in a high-yield savings account. Second, for spending needs due within a year, maintain those funds in the savings account for immediate access. Third, for needs 12 to 36 months away, construct a ladder of short-term treasury bills or certificates of deposit to capture prevailing yields while staggering maturities to reduce timing risk. Fourth, for needs 36 to 60 months away, consider slightly longer T-bills or a short-duration government bond fund while keeping a liquidity buffer in the HYSA. Finally, review your plan quarterly to roll maturing instruments and to adjust the mix as your deadline and interest rates evolve. Let us quickly tackle common myths. First, the fear of investing at the peak does not apply for short-term goals, because equities should not be used in the first place. Second, a safe, modest return can be the optimal choice if it prevents a large drawdown at the wrong time. Third, missing out on gains is not the issue. Meeting your goal on schedule is. Finally, even though prepaying low-rate debt can be sensible in some contexts, When you have a near-term spending need, the priority is to preserve that capital in safe, liquid instruments. Here is a direct comparison. Equities offer high expected returns over long horizons but come with high short-term volatility and outcome uncertainty in the 2 to 5 year window. Large drawdowns can occur close to your spending deadline. In contrast, short-term vehicles such as high-yield savings, treasury bills, CDs, and I-bonds offer lower but more predictable returns, higher liquidity in many cases, and known terms such as penalties and lockups. These features align better with fixed spending deadlines and the goal of capital preservation. Question: you plan to use $40,000 for a home down payment in 3 years. Which option best aligns with capital preservation? Options: A. 100% in an S&P 500 index fund. B. A 3 to 12 month treasury bill and certificate of deposit ladder with a high-yield savings buffer. C. 100% in a small-cap stock ETFD, and 80% stocks and 20% bonds target date fund. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is B. A short treasury bill and certificate of deposit ladder with a high-yield savings buffer emphasizes preservation, liquidity, and predictable returns, which is appropriate for a 3-year horizon. Equity-heavy allocations in options A, C, and D carry too much short-term volatility for a fixed deadline. Question: which statement about I-bonds is most accurate for short-term planning? Options: A. Fully liquid from day one with no penalties. B. Must be held at least 12 months. Redeeming before 5 years forfeits 3 months of interest. C. Always earn more than treasury bills. D. Tax-free at the federal level. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. I-bonds require a minimum holding period of 12 months, and if redeemed before 5 years, you lose the last 3 months of interest. They are not fully liquid from day one, they do not always out-earn treasury bills, and their interest is not tax-free at the federal level. Here is a quick markdown recap of the key takeaways. First, prioritize safety for any funds needed within 60 months. Second, accepting a guaranteed but modest return is smarter than risking a large drawdown right before your deadline. Third, deploy tools like high-yield savings accounts, certificates of deposit, treasury bills, and I-bonds based on when you will need the money. Finally, revisit your plan quarterly and ladder maturities to manage reinvestment and timing risk. To summarize, funds you will need within 5 years should not be exposed to equity market volatility. Corrections are unpredictable, and recoveries can take longer than your timeline. Safer instruments include high-yield savings accounts, certificates of deposit, treasury bills, and I-bonds. Earning a stable return in the 3 to 5% range is preferable to risking a large loss. Implement a laddered approach and review it quarterly to keep your plan aligned with your deadline. Before we close, here is an important disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation is unique, and you should conduct your own research and consult a qualified professional before making decisions. Thank you for watching. If this helped you protect your goals, please like the video, share it with someone who is saving for a major purchase, and subscribe for more practical money guidance. Finally, tell us your timeline and how you plan to allocate your short-term funds in the comments.